Good morning, students. Welcome to our online classes. Students, today once again we will read the chapter 3, that is Money and Banking, from the book Introductory Macroeconomics. And today in this part 3 of this Money and Banking video, we will discuss the following topics. Bank rate policy, or also called bank rate, open market operations, cash reserve ratio CRR, what is meant by CRR, statutory liquidity ratio, SLR, exchange control. So these topics we will discuss in today's video. So students, listen carefully. These are the functions of banks, and you should know these technical terms, the meaning and the concept, so that you can do better in your final examinations. So students, our first topic is bank rate policy. Students, actually bank rate policy or what is bank rate, both are same. Bank rate policy and what is bank rate, both are same. So you should know what is the bank rate first. First I'll explain in a simple and single sentence, then I'll explain in detail. So what is bank rate? Bank rate refers to the rate at which central bank will advances loans to all commercial banks. What type of loans it will advance? Long term loans. I repeat, bank rate refers to the rate at which the central bank will advance or will give loans, long term loans, to all the commercial banks in the country. So the central bank gives loans to the commercial banks, but at a certain rate of interest. That is called bank rate. It will not give free of cost whenever any commercial bank seeks loans. So it will give at certain rate, the two on interest. So bank rate refers to the rate at which the central banks advances long-term loans to all commercial banks in the country. So if you come in detail, so what is said here? Bank rate is the rate at which the central bank advances loans to commercial banks, all commercial banks in the country. If the bank rate increases, the rate which is charged by the RBI increases, then what are the consequences? Suppose if the bank rate increases, then what are the consequences will be there? So the following are the consequences, students. One is cost of borrowing from RBI will increases. Cost of borrowing from RBI increases. I repeat, the following are the consequences if the rate or bank rate increases. Number one, cost of borrowing from RBI increases. Commercial banks, when they ask loans from RBI, the rate will be more. Second one, so when the rate will more, then generally all the banks will prefer to borrow lesser cash. They'll borrow less amount. So commercial banks will purchase less, they'll borrow less. Then when the commercial banks will borrow less amount, naturally they will also lend less amount in the form of loans to the needy people, public. They will lend less amount to the public in the form of loans. That is the result. Next one, bank also increase lending rates. Since commercial banks have taken at more rate from RBI or central bank, naturally the commercial banks also will charge a high rate of interest whom they have given the loans. Next one, when the banks will charge more rate to the needy people whom they give loans, naturally the people will not prefer to take more loans from the bank. people will not take more loans from the bank. I mean, this will discourage the businessmen, the farmers, okay, from taking loans from the bank because the bank rate was more, charged more by the commercial banks. Okay, when the loans will be taken less by the people, this reduces the volume of credit and money supply. When people take less loans, then the circulation money, the supply of money, okay, the credit flow in the money flow in the country will be reduces. Next one, a decrease in bank rate. Suppose the bank rate decreases, opposite. When the bank rate decreases, naturally commercial banks will borrow more money from central bank and they lend more amount in the form of loans to the needy people. More people will take loans and the circulation money will increase in the country. So this is about bank rate or bank rate policy. Our next topic is open market operations. It can be said in the form of an abbreviation OMO, open market operations, OMO. So what is meant by open market operations? In a single sentence first I'll tell you, then I'll explain. So open market operations is nothing but buying and selling of government securities by the central bank from the public or to the public. I repeat, open market operations are nothing but buying and selling of government securities through central bank from the public and to the public. Whom they are selling? To the public they are selling. If they want to purchase, okay, buying, from whom they will purchase? From the public. So buying and selling of government securities through central bank to the public or from the public is called OMO or open market operations. Students, now I am going in detail. Open market operations is the buying and selling of government security by central bank from the public or to the public and also banks on its own account. Now, suppose they are selling the securities. Sale of government securities will reduce reserves. When the government will sell the securities, when the government is selling the securities through central bank, then what will happen? It will reduce the reserves, the money reserves, the cash reserves. It reduce. That is the first. Sometimes what will happen? RBI sells securities. RBI selling securities. Okay, banks give RBI a check. Banks give RBI a check for the securities. When you purchase something, you have to lend money. You have to lend money. Instead of lending money, you are giving what? Check. So RBI sells securities. Bank gives RBI a check for the securities. RBI collects the amount by reducing the bank's reserves by the particular amount. I repeat, RBI collects the check by reducing the bank's reserves by the particular amount. This directly reduces bank's ability. This directly reduces the bank's ability to give the credit. So when you sell the securities, then the bank's ability will be reduced. What ability? To give more credit to the public in the form of loans. Therefore, this decreases money supply. This also results in what? Decrease in money supply in the economy. When money supply will be decreased, then we can call it as what? Deflation. We can call deflation. On the other hand, when RBI will buy the securities from banks, so far what I said? Sale of government securities will reduce reserves. Now, when RBI buy securities from banks, then what will happen? RBI give the bank a check. Now RBI is giving a check to the commercial bank. I repeat, when RBI buys securities from the banks, then RBI will give a check to the commercial banks on itself in the payment of the securities. When the check clears, RBI increases reserves of the bank by the particular amount. This directly increases the bank's ability to give credit. So this will increase the bank's reserves and also bank's ability to give more credit to the needy people. Thus money supply increases, and here money supply increases means what? The flow of the circulation money in the economy will increase, which leads to inflation. So this is the topic. Now student, we are going to next topic, that is cash reserve ratio. cash reserve ratio. I mean CRR. So what is meant by CRR? First you should know CRR means what? Cash reserve ratio. So in one sentence, how can I explain? It is a part of LLR. Actually CRR is a part of LLR. CRR is a part of LLR to be kept with the central bank by the commercial banks. I repeat, CRR is a part of LLR which is to be kept with the central bank by the commercial banks. I mean cash reserve ratio is kept by commercial banks with the central banks. I repeat, CRR is a part of LLR which is to be kept with the central bank by all the commercial banks. Now in detail, here is this CRR, cash reserve ratio. It is of certain ratio of commercial banks. It is of certain ratio of commercial banks. Okay, net demand deposits and time liabilities which it has to be kept with the central bank as cash. That means all the commercial banks in the country, they are keeping certain amount of their cash as reserve in the RBI or central bank. Now the question is this, how these commercial banks will get that cash? They will get the cash from the time deposits or the deposits which are made by the public or other time liabilities. So I repeat, CRR is a part of LLR. It is a amount in the form of ratio which all commercial banks are keeping with the central bank, and this amount they are getting from the time deposits or net demand deposits. I mean whatever amount the public kept in the commercial bank. Suppose 10 crore rupees of amount is kept by 2000 deposits in the commercial bank. So out of 10 crore, how much percentage the commercial banks are keeping with the central bank? That is called cash reserve ratio. Now it will be decided by central bank that how much they have to keep. Now if RBI increases CRR, suppose if the RBI is demanding more CRR from the commercial banks, RBI is restricting all the commercial banks to deposit more amount with them. Okay, if the RBI increases CRR, banks have to keep a large percent of their deposit with the RBI. That means they have to submit more, they have to keep their cash reserves more with the commercial bank, central bank. When they keep more amount with the central bank, then what will happen? The banks will have less amount for the daily transactions and to lend money in the form of loans to the needy people. So their credit giving ability decreases. Whose credit giving ability decreases? Commercial banks' ability will be decreases, and money supply also decrease in the economy. Conversely, if RBI will decrease CRR, suppose RBI decreases CRR, that means very less proportion or less amount the commercial banks has to keep with the RBI. Then what will happen? All the commercial banks will have more amount, more credit with them. When they are having more credit, then their ability to give credit to the public will be increased. Hence the circulation of money, the flow of money in the economy will be increased. So this is about CRR. Now moving to next topic, that is statutory liquidity ratio, that is SLR. Statutory liquidity ratio, SLR. So single sentence if you want to know about this one. The part of LLR, here SLR means what? The part of LLR kept by the banks with themselves. How much amount the banks has to keep with them. What purpose they are keeping the amount? For the daily transactions and also to give certain amount in the form of loans to the different fields, agriculture field, industrial field, personal loans, etc. So that part of LLR which kept by LLR kept by the banks with themselves in the form of liquid assets. Liquid assets is called what? SLR. Is called SLR, statutory liquidity ratio. So in detail if you go, listen students. Statutory liquidity ratio means SLR. It is the ratio or percentage of net total demand deposits and time deposits of the commercial banks, which they have to keep in the form of liquid assets, the form of cash as excess reserves. They have to invest the government securities or in securities approved by RBI. Whatever amount they are keeping with them, that has to be lent to the public, or they have to purchase something, and current account balances with other banks. If RBI increases SLR, suppose if RBI or central bank increasing SLR, then credit giving ability of banks decreases. If SLR is increased by the central bank or RBI, then the credit giving ability of the banks will be decreased and money supply will be decreasing in the economy. If RBI decreases SLR, then what will happen? The credit giving ability of the banks will be increased and the flow of money in the economy will be increased. Clear, students? Now, moving to our next topic, that is exchange control. What is meant by exchange control? Listen. Exchange control means maintaining or maintains the external value of currency. That I told you in the functions of central bank. It is central bank that maintains the external value of Indian rupee in the international market. Okay. So exchange control, that means it maintains the external value of currency. Every citizen should deposit foreign currency. Every citizen should deposit the foreign currency they earn with RBI. Every citizen has to deposit the foreign currency with RBI, and they can get the foreign currency from RBI with application. Suppose you are going to some other country, you need foreign currency, so you have to deposit our Indian currency to the bank and you have to collect the foreign currency from there, and you have to go to the other country so that you can do the transactions there. I repeat, exchange control means it maintains the external value of the currency. Every citizen should deposit foreign currency they earn with the RBI, and they get foreign currency from RBI with the application. Now, apart from this one, student, I want to explain one important topic, that is what are the functions of commercial banks. That is, what are the functions of commercial banks? It will be asked. Generally, what is bank? Before knowing what is commercial bank or what are the functions of commercial bank, first of all you should know what is a bank. A bank means any financial institution, or I can say bank is a financial institution. Bank is a financial institution that accepts deposits from the public who are having surplus money with them, more money with them apart from their daily expenditure. Okay, so bank is a financial institution which accepts deposits from the public and lends money to the needy people for some productive purpose. So all banks will accept deposits from the public, not by force, voluntarily. And when the public will deposit their money in the banks, in return the banks are giving some interest. Now whatever amount they collected in the form of deposits, out of that some part they will keep for the daily transactions, and remaining amount they will lend to the needy people in the form of loans to start in a productive work, useful work. Now how much amount they have to keep and how much amount they have to lend in the form of loans, that we will lead in the next video. Okay. Now that is called bank. Now what all banks will perform, all commercial banks will perform, what are the functions? Very simple. Accepting deposits from the public who are having surplus money with them. Second one, lending money or advancing loans to the needy people for starting productive work. Apart from these two, now modern commercial banks are performing so many functions. One is, that is locker facility. Locker facility, you can keep your valuable documents, money, jewelry, etc. in the bank's locker facility. Next one, that is next one, preparing DD, demand drafts. Okay, they are also issuing what? Demand drafts. Clear? So many functions are there of commercial banks in modern times. So here two main functions are given, but I said two more are there. One is locker facility, and also providing several other services, that is collecting fees from schools, colleges, also that is there. Okay, similarly that preparing the demand drafts. Okay, all these things. Also that NIFT. Okay, all these things. Now accept deposits and advance loans. These are the two main functions of every commercial bank. Now, all commercial bank accepts a deposit from the public, from whom those are having surplus money, the leftover money after their expenditure. People can deposit their cash balances as a checkable deposits or non-checkable deposits or in the form of fixed amount, etc. Now, advances loans. Commercial banks advance loans mostly for productive purposes. Productive means useful purposes like purchase of any plant or machinery to do changes in agriculture. Okay, they also offer loans for consumption purpose as well. Okay, personal loans, purchasing car, etc. Like for buying consumer durables like cars, etc. Okay, so these are the functions of what? Commercial banks. So now students, one more thing. How banks will do the credit creation. Another important topic today I am covering, that is credit creation. Okay, what is meant by credit creation? How this credit creation is been done? Who will do this one? So students, generally one question will be asked in the board examination. What is meant by credit creation and how commercial banks are doing the credit creation? The question is like this: explain the process of credit creation by the commercial banks. So listen student, this question is very important. A commercial bank is considered as a creator of money. Every bank is a creator of money. Every bank is a creator of money. How they are creating? They are not printing currency, but they are creator of money. How? Listen. So every commercial bank is considered as a creator of money in the economy on the basis of its basic function of receiving and accepting deposits from the public. The commercial banks use the money in these deposits to give loans. I told you, whatever amount they'll get from the public in the form of deposits, certain amount they'll keep with them for the daily transactions, remaining amount they'll give in the form of loans. This is the basis. So whatever amount is possessed by the commercial bank, that is the basis for what? Credit creation. So this is the basis of deposit creation. How much is the deposit creation determined by the amount? How much is the deposit creation is determined by the amount of initial deposits by the public and the legal reserve ratio, LLR. Let us now explain the process of money creation or deposit creation or credit creation like this. Listen students, suppose initially people deposit 100 rupees. I repeat, suppose initially people deposit rupees 100 in a bank. The bank used this money for giving loans. Okay, but the bank cannot use the whole amount of the deposit for the purpose of giving loan. Yes, it is legally compulsory. It is legally compulsory for the banks to keep a certain minimum amount or minimum fraction of the deposits given by the public with them as cash in the banks for the daily transactions. This fraction is called legal reserve ratio. That fraction only is called legal reserve ratio. Okay, LLR. That much amount which the commercial banks are keeping with them in the form of cash for the daily transactions, which is fixed by the central bank. Now the question is just, how much amount the commercial banks has to keep with them for the daily transactions in the form of cash, that is LLR. Who will decide that one? That will be decided by central bank. The part of ratio which is kept by the commercial banks with the central bank is called cash reserve ratio. That amount which the commercial banks kept with the central bank, that's called cash reserve ratio. The other part which is kept by the banks themselves is called statutory liquidity ratio. Okay, now explanation of the process of money creation. Listen, suppose the initial deposits is by the people in the bank is rupees 100. and the LLR is what? 20%. Rupees 100 is the deposited amount and the LLR is what? 20%. That means out of 100%, 20% they'll keep with them. Remaining 80%. See, further suppose the banks keep only the minimum required is rupees 20. So out of 100 rupees they are keeping with them 20 rupees. That is called LLR as cash reserve. So now they are free to lend the remainder. That is what? How much is remaining? 80 rupees to in the form of loans. Suppose they lend 80 rupees. Suppose they are lending 80 rupees for this what? Advancing loans for various purposes. They open deposit accounts in the names of the borrowers. Now, as all the transactions are routed through the banks, the money spent by the borrowers come back into the banks. Now, commercial banks advances loans. The 80 rupees they advance in the form of loans. Now, when we are giving loans, the banks are giving loans at certain rate of interest. So, when the borrower is taking loan, so after a specific period of time, the borrower again return back the principal amount along with the interest. Okay. So that interest which is paid by the public or depositor or borrower of the loan, again from the investor, again they'll keep 20% with the bank, again remaining 80%, again they'll give in the form of loans. Again, whatever the borrower is repaying the principal amount along with interest, again that interest amount, again 20% they'll keep, again 80% they will lend in the form of loan. So in this way, what will happen? The banks are increasing their cash reserve. They're increasing the credit. They're doing the money creation, credit creation, deposit creation. So in this way, all the banks are doing the credit creation. Okay, students. Thank you, students. This is the end of our today's video. In the next video, we will come up with some other topics from the same chapter, money and banking. Thank you.